Investors often do better by staying patient than by constantly reacting.
You need to act every day or every time only if you are a trader. If you're an investor,
So that's the
frankly,
distinction,
it won't matter. Pick a few good stocks or a good mutual fund or whatever and let your money work for you. So it should not be a static portfolio. You should keep investing at regular intervals.
Everybody is chasing mid caps and small caps. Any reason why large caps have been the laggards?
Sometimes people associate large caps with boredom. You said everybody's chasing mid caps and small caps.
Yeah.
I say everybody's chasing.
What if the markets were to crash? What should SIP investors do if such an eventuality comes? I know this is too far-fetched.
It's not far-fetched. It will happen.
Okay.
At some point in time, it will happen. Maybe not tomorrow. And the whole concept of SIP is to
Following the brutal market correction this March and the subsequent recovery, the market seemed to have recovered a bit. But then, as we know, the fragile truce between Iran, US and Israel is more fragile than ever. From market rallies to market corrections, from investing in SIPs to finding the next multi-bagger, Mihir Vora, Chief Investment Officer, Trust Mutual Funds, joins us on the Rediff podcast. Mihir, welcome.
Thank you so much for having me, Prasanna.
Before we start, Mihir, I wanted to ask you, I saw your picture on LinkedIn profile, you're kayaking. Is kayaking a hobby you love?
No, that was on a vacation with my son.
I could make out that it was you and...
It was the backwaters of Kerala.
So how was it? And
Oh,
what was it?
lovely experience.
Mihir, let's talk about the market. The market seems to have surprised everyone after the market, after the correction this March. How do you see a few months ago, there was anxiety about valuations, about geopolitics, and of course the FIIs selling, which still remains a concern. And markets have bounced back today a bit. Have investors and markets become too optimistic?
So let's just put things in perspective. Where we stand today, this is July 2026. The markets have not gone anywhere for a while now, right? So we probably saw the peak in the month of September 2024.
Yeah.
And after that, it's been sideways, up and down.
Yeah.
We've seen many movements, but net,
It has gone nowhere.
It's gone nowhere. But in the meantime, earnings have continued to grow for the corporate sector as a whole. So we've seen a time correction. We've seen a price correction. And because earnings have grown, we have also seen a valuation correction. And on top of it, if I were an FII, I would see that there's been a currency correction also, right?
That's an added worry for the FIIs.
Absolutely. So, worry but opportunity also, right? Because one can say that there was a bit of a froth 2 years ago, but that froth is completely gone.
Okay.
So, I don't think there is any concern on valuations anymore. If you look at the broad indices, whether it's a Nifty 50 or NSE 500, we are trading at long-term average valuations. So 10-year, 15-year average is around the current levels. So that there's no longer talk of froth in the markets at the aggregate level. So that's one. Second is earnings continue to grow. We saw the last few quarters, in spite of all the uncertainty, even in the March quarter, the broad market earnings were pretty robust. So there were more upgrades than downgrades in the estimates. Now, of course, after that, we have seen oil prices spike up in this quarter. So on a sector by sector, there might be some margin issues in some of the segments, but the underlying demand conditions are still robust.
Okay.
Right. So whether you see the nascent pickup in private sector capex, or you see the consumer demand, proxies like credit growth, or GST collections, or income tax, advance tax collections, most of them are looking good, including auto sales numbers. So I think the private sector capex, government capex, and the underlying consumer demand seems to be holding up in spite of all this volatility. So that makes me optimistic that with valuations no longer being an overall concern and earnings continue to grow, it sets a good base for the market in the next few years because we are starting off from a normal base, so to say. So as long as earnings are backed up, we don't have to worry about valuations. And even if earnings grow at 12-13%, markets can give you those kind of returns, which is not a bad thing in the scheme of things.
Okay. Given the tapered start to the monsoons, and you talked about consumer demand picking up good credit growth, do you think that can act as a bit of a spoiler as far as consumer demand part of the equation is concerned?
Yes and no. Yes, in certain segments. So, for example, if the monsoon really gets worse and thankfully we had some rains a couple of
in the
weeks
beginning
ago,
of the
and
month.
significant rains. But that should impact certain sectors of the market, like say the lower ticket consumption items like FMCG, some of the rural segments like say tractors, right? But compared to 10 years ago or 15 years ago, the size of the rural economy is smaller than what it was before. The urban demand and urban economy are much bigger drivers than earlier. Also, these segments are no longer large chunks of the market cap, right? Again, 20 years ago, FMCG was a far bigger market cap,
huge market driver
as a percentage of the market cap, but now no longer the case because other segments have grown. So yes, there will be an impact, but only in a limited portion of the economy and a limited portion of the market.
Okay. Last week you launched Trust MF Large and Mid Cap Fund. How is the feedback from investors? And any reason, since you talked about valuations being there's no froth now, is it a good time to enter large and mid caps?
Oh, absolutely. The feedback is good because luckily our existing funds are doing extremely well. So that's a tailwind of performance that we've seen. And the funny part is we are a young fund house, so we started about 2.25 years ago. And the markets have gone nowhere, right? But we have generated significant alpha in most of our funds. So the experience of customers has been good. And the funny part is the same question was asked from us 2 years ago also. Oh, is this the right time to launch a flexi cap fund? Then second fund was, oh, is this the right time to launch a small cap fund? And then multi-cap fund. Again, is the right time to launch a multi-cap fund? But in all the cases, we have shown that as long as you stick to your stock picking and you generate alpha, there are enough opportunities in the market. So I think even in the large and mid cap space, first of all, it's a core category. So as a young fund house, we have to offer all the products to our customers. So that's one. And valuations, as you just discussed, are at a good level. And the good part about the large and mid space is that sometimes people associate large caps with boredom. And mid and small caps is where the exciting stuff is happening.
The momentum is
normally
momentum.
that's the perception,
Momentum
right?
investing.
Momentum or the higher growth segments, whatever you call it, are perceived to be only in the mid and small cap, which is true. A large number of stocks are there in mid and small cap space. Huge amount of stock picking can be done. But if you see, even in large cap space, there are enough stocks in the high growth categories. So, for example, defense is a high growth sector, right? The largest defense company is a large cap, which is the aircraft manufacturer, right? But if you want to go to missiles, the largest missile manufacturer is a mid cap, right? The CDMO is a high growth segment. So the largest company and growing very well in the CDMO segment is a large cap. But the fastest growing company in the CDMO space is a mid cap, right? Similarly, the largest steel manufacturer is a large cap, but the largest stainless steel manufacturer is a mid cap. So, the largest jewelry manufacturer is a large cap, right? But the largest eyewear retailer in the same consumer discretionary space is a mid cap. So, if you pick and choose the right stocks in the right sector, there is the opportunities both in the large cap space as well as the mid cap space. So that's how we are positioning the fund.
Okay, that's where I guess you have put more emphasis, selecting the right stocks and the right sectors.
Absolutely.
So tell us what goes on in the mind of a chief investment officer of a mutual fund company when he is at a current juncture, looking at the geopolitical tensions, the forever Trump tantrum. How do you look at selecting stocks, companies? What are those 3 or 5 important things that you look at before investing in a company or in a business?
First of all, let me just elaborate on what our investment philosophy is, what our style is.
Philosophy also behind the large cap and mid cap fund.
And the overall fund house philosophy, right? So as a fund house, we are growth investors. And by growth, we mean earnings growth. We've experienced, over the long term, it's ultimately profit growth which drive stock prices. And if you look at the compounded returns from stocks, they broadly match the compounded growth in profits, right? So as long as you figure out where the fastest growth in profits is going to be, those are the segments you want to be in. And of course, you want to buy them at reasonable valuations.
Exactly, that's
right. So growth at reasonable valuations is what we stand for. And we're not in the camp that we'll buy it only when it becomes dirt cheap. No. As long as you're buying it at reasonable valuations, we are banking on earnings growth to deliver the stock price performance. If we get lucky and get it cheaper, fine, but we're not going to wait for it. We ultimately want sheer growth of earnings to drive the stock price. So that's one key thing in our approach. We don't wait for things to become value or too cheap. We're paying for growth at a reasonable price. But I would say that a lot of funds are growth investors, and a lot of fund managers say that we do investing at by the growth at reasonable price kind of an approach. People normally use the word price. We say valuation, and that's a fine difference, but it's important.
Okay.
The differentiation in our style of growth at reasonable valuations versus others is in the way we look at valuations. Okay. And that's where the whole concept of terminal value investing comes in, right? Very simply put, typically when you, or as an analyst or even as a fund manager, when you look at a stock and you try to make projections, it's easier to predict the shorter term.
Yeah.
Right. So you look at the last 5-10 years of performance. You look at the company's commentary, transcripts, earnings calls, etc., and interviews and guidance, and all. The company does give some guidance. This is what we're going to plan to do in the next 1, 2, 3 years or so. So normally, if you look at research reports or any projections, they basically focus on the next 2 to 3 or 4 years maximum. The longer term is difficult to predict. So the longer term you try to forecast, it becomes fuzzier and more uncertain. So it's not comfortable, right? So it's easier to predict the shorter term, far more difficult to take a view on the very long term prospects, right? So then people, what they do, typically tend to look at the next 2 to 3 years, apply some kind of a multiple link to the market, etc., and arrive at a target price or a fair value of that stock. This is the EPS, this is the PE that I would like to give this to this stock or sector, because market is trading at 22. This is a higher growth stock, maybe I'll give it a 25 or 30 PE, and then you arrive at a target price or a fair value of the stock. This is the normal approach to growth investing. What we've seen is that this approach does not work in the long term.
Okay.
Right? And that's because we are looking at some of the highest growth stocks and sectors. And we are looking at stocks and sectors which we expect to grow for a very long period of time. So our desire is to find stocks with a long runway of growth.
Okay.
Right?
Long would be 10 years, consistent growth.
Where we can see that the potential to grow is not limited to the next 2 to 3 years, but maybe 5, 10, 15, even 20 years in a lot of cases. Secular trends, and there are many factors based on that, which will drive that growth. We'll come to that later. But essentially, the idea is to find stocks which can grow at high rates for long periods of time. So when the market or you value such a stock, it is far less important what the earnings growth will be for the next 2 to 3 years.
Okay.
Of the total market cap today that the market is giving to that stock, 70 to 80% of that market cap cannot be explained by the near-term profits. Okay. Which means whether you like it or not, the market is already giving a value to the longer term profits.
That's an important insight.
Right. And you don't want to take that call because it's difficult to predict the longer term. It's uncomfortable, right?
Yeah.
But the market is already giving it. So when you say a stock is trading at a PE of 50, what does it mean? Let's say the profits are 100 crores, which means that the market cap is 5,000 crores, right? 5,000 by 100 is a 50 PE. And as an analyst, if you predict high growth for the next 5 years, what would you do? You would say that a good growth is 25%, compounded profit growth. So you'll say 100 is going to 125, 125 is going to 150, 150 is probably going to 200, and 225 after that, or 250 after that. But if you take the total of the next 4 or 5 years, it won't be more than 800 crores. I'm not even taking the discounted value, just simply adding the profits without discounting it. So 800 crores, only 800 crores out of 5,000 crores can be explained by the next 5 years. Near term
growth projections.
4,200, more than 80% of the valuation is coming from what the market believes is the value of the longer term profits.
Okay. What happens after the next 5 years?
After the next 5 years. Exactly. So in this case, 4,200 crores assumes a certain longer term growth rate, very long term sustainable growth rate for that stock. That may be 13% or 15% or whatever it is. So our job then becomes to figure out whether this 4,200 crores, which implies a certain long term growth rate, that growth rate, is it too low or too high? Right? And invariably what people tend to do is, because you can't predict the longer term, they tend to assume a lower longer term growth rate, which means that typically tend to believe that the 4,200 crores, which is the terminal value, is too high.
Okay.
Because 50 PE, right? That's where the biggest mistake happens.
Okay.
Because stocks which don't stop growing beyond the next 4 or 5 years, they will continue to trade at higher PE multiples because the terminal value. So this 4,200 crores is what we call terminal value.
Okay.
So terminal value is the value of the longer term profits, not the short term profits.
Okay.
So our job is to figure out whether this terminal value currently which the market is giving is too high or too low.
Okay.
And if we say that we believe that this segment or this stock can grow its top line and bottom line by say 20% for 20 years,
Yes. Okay.
that's a big
That's
difference.
huge. Yeah.
That's huge. And for us, if you and it's not difficult to find examples of stocks which have done that in the past.
Okay.
There are so many stocks which have done that in the past. 20 years ago, they were looking expensive then.
Right.
But they continue to compound at 20% for 20 years.
But isn't it a challenge now to find those kind of stocks which will
It's
deliver over 10 years,
Not
15
now.
years?
It's always going to be a challenge.
Okay.
And the challenge is not so much in finding the stocks. Some of the stocks, for example, today the largest jewelry manufacturer in the country, right? It was not an unknown stock 20 years ago.
Yeah. Okay, but nobody believed that it would
Exactly.
keep
So
on churning this
you-
kind of growth rate.
So it's not about picking a micro cap or picking a mid cap, a rare where nobody knows about it. It was and the largest private sector banks, for example, 20 years ago, right? They were not unknown banks.
Yeah.
They were all big brands,
Yeah.
but the view was whether they can compound their earnings at 15%, 20%,
Sustainable
25%
rate.
for a long period of time.
Yeah.
You just have to take that view. You didn't have to worry about the quality of the promoters or the quality of the company. It was right there in front of you.
Okay.
So it's sometimes people say, oh, multi-baggers can only be found in micro caps or small
Micro-
caps. That's not the case.
Okay. So one thing, Mihir, you have repeatedly said is that investors often do better by staying patient than by constantly reacting. What would you tell? How does this match up with what the market has done in the last 2 years? And how does an investor, ordinary investor like me, know whether it's time to act or simply stay put?
See, first of all, you need to act every day or every time only if you are a trader.
Okay.
If you're an investor,
So that's the
frankly,
distinction,
it won't matter. And for traders, I don't have too much of advice, frankly speaking, because SEBI has come out with all those statistics, about how much
95%
money is
of
lost by
traders lose
traders,
money.
how many percentage of
And that
traders
is what
lose money.
needs to be highlighted, emphasized again and again and
Absolutely.
again, because people are getting into this trading mode. They think that trading can make them Warren Buffett.
No, absolutely. So it's a adrenaline rush or dopamine kick, whatever you call it. But so I frankly don't have too much of advice to give to traders.
Okay.
But as an investor,
Yeah.
I think doing nothing is the best thing you can do most of the times, right? And having a plan in advance is the best thing you can do.
Okay.
Right. So if investing is not your full-time job, which I guess is the case for 99% of the viewers, it's they have a day job or a business to do. So you can't really study so many companies, so many opportunities. The only option is to pick a few good stocks or a good mutual fund or whatever, and let your money work for you.
Okay.
And more importantly, keep adding to that. Savings should also compound. So it should not be a static portfolio. You should keep investing at regular intervals.
For almost 2 decades now, mutual fund SIPs has been the go-to investment avenue for ordinary Indians to generate wealth. But in the last few years, there's a growing narrative that tells that mutual fund SIP investors are providing easy liquidity and exits to FIIs, family offices and high net worth individuals and promoters. As a mutual fund investment officer, how do you look at this? Does this narrative worry you? Do you think that these kind of narratives impact mutual fund SIP investors' psyche, that, oh, this is where we need to stop, we need to hold back? How do you look at this narrative?
Oh, I think it's a very absurd narrative. Let's face it, first of all, we are an open market, right? And we have opened up our market to FDI, to foreign portfolio investors, and they have gotten a lot of capital over the last so many years, right? And the thing is that your transparency and your credibility will only get enhanced when people have experienced a full cycle. They've invested, they've provided capital when you needed it, whether it's a PE fund or a venture capital fund or even FPI investors, right? When they were buying, somebody was selling because that somebody needed the money, right? And now that they've made some money, and they've been here for a long period of time, right? So if you look at the last 25 years, net FIIs have put in money every year. In the last 25 years, there are probably 4 years where FIIs were net sellers. FDI is separate. FDI is anyway positive most of the time, all the time. So they've been investors for very long, right? And if some of them have, their fund life coming to an end, they need to make profits. I mean, what's the harm? What's the harm, right? The point is that if these global investors have a good experience of entry, staying put and, letting the money work and exit, that credibility that they get when they launch the next fund for India is huge, right? Because look at China. The China stock markets have done nothing for 25 years. The GDP has grown. The stock market returns have been absolutely zero, right? So experience out there has not been great. And the point is that as a country, let's also realize that we need foreign capital because we run a trade deficit and we run a current account deficit, right? In spite of services exports, we run a current account deficit. So where is the deficit going to get funded from? It has to come from foreign capital, right? So we have to have a good experience for the foreign investors to keep coming back to India, right?
Sure.
And the point is that even when FIs are selling and we are accumulating as local institutions, right? When they come back next time, they'll buy it from us at a higher price.
Okay.
And they will come back. This logic of we are giving exit to FIs only works when we take the cutoff date as today.
Yeah.
But the markets are going to stay open for the next 25 years.
Yes.
So FIs are going to come back. And when they come back, we'll sell it to them at higher price. It's a cycle.
Okay.
It's a circle of life.
Yeah, any past instance that comes to mind where FIIs have sold heavily, domestic investors have bought in heavily, and domestic investors has had the last laugh?
So the thing is that this whole culture of regular investing has only gotten inculcated and grown exponentially in the last 10 years, right? So this is the first 2 years that we've seen that FIIs have sold so heavily. And we can go to the reasons are separate. But the thing is that in India, we are seeing it for the first time. That FIIs are selling and domestics are buying aggressively. But when I started my career in the 90s and the 2000s, markets like Korea, Taiwan, Japan, they did not care about FIIs. Because there, the savings pool was already so large and the domestic investor base was already so large that they were able to give competition and even more than competition to FIIs even then, 30 years ago, right? So it is not new. This phenomenon of domestic savings pool being so large and strong is not a new phenomenon. It's new probably for India. So we are only, going in. We are only, I would say, repeating the trends that we've already seen in the past.
Okay.
Essentially, what is the concept? The concept is, as domestic income levels rise, savings also rise. And when savings rise, you will see diversification of savings into financial assets away from physical assets. So every economy, if it's poor, the first asset they buy is either real estate or gold. That's the Asian way of doing things. But as savings rise, then there's a diversification of assets into financial savings. So we are seeing that. It's not new.
When do you think the FIIs will come back and buy at higher price?
Very soon.
Very soon.
Yes.
And what makes you optimistic about this?
Yeah, so a couple of things. First of all, let's delve into the reasons why FIIs sold in the last 1.5 years, right? Two things. In 2024, if you look at the past 5 years in 2024, India was the best performing markets, one of the best performing markets in the world in dollar terms, right? So India became a favorite market. Post-COVID, especially the way we handled COVID and the way the market gave returns. Everybody was phenomenal. And FIIs followed that. They put in money, right? For 5 years, India was the best performing market, right? And when there is a momentum, things always overshoot a little bit.
Yeah.
So by 2024, there was a bit of valuation froth, right? By 2024 in certain pockets. More importantly, in 2024, we also saw AI rising as a theme, right? It started with the US. Then, of course, the key trigger, I think, was when China launched its DeepSeek model. That's when Asia, as an emerging market, also came into the picture that these guys can also participate in the AI rally. So India was already frothy.
Yeah.
China was horribly underperforming and horribly cheap.
Yeah.
It had become too cheap to ignore. And this DeepSeek moment gave the trigger for FIIs to scramble into China, because they were so underweight China and so overweight India that even if China outperformed a little bit, they would underperform because of the underweight in China. So they had to scramble and cover their underweight positions in China. Where do they get the money from? From where they are overweight.
Yeah.
That was India. So I think that was one trigger. And second is, as AI progressed, people also realized that semiconductors and chips are in short supply.
Yeah.
So again, it started with the US, with NVIDIA, etc. But then it came to the memory storage, DRAMs, etc. into China, so into Taiwan and Korea and Japan.
Yeah.
Right. So those markets also started pulling money. So I think it's a cycle. There will always be something which looks better. Was it something that India did bad as an economy? No. 2 years ago, in 2024, we were the fastest growing large economy in the world. Today also, we are the fastest growing large economy in the world, right? So that's not changed.
Okay. So the FIs are coming with the bagfuls.
So
if
now,
not now, maybe in the next 2 quarters, 3 quarters.
Absolutely, because now if you see,
Because as you said, the froth's already gone.
Froth's gone from India, and too much froth has probably built up in the AI theme.
Exactly, and they're being hammered.
Last
brutally.
2 months, I would say. Last month you see Korea is down 20%, Taiwan is down significantly.
Yeah.
The tech stocks are correcting, so that froth is correcting, and the moment they stop getting obsessed about that theme, money will come back to India.
Another debate that refuses to die about large caps versus mid caps and small caps. Where should fresh money go today? If someone is starting a SIP today, should they lean towards large caps, mid caps, or simply diversify and stop worrying about the caps business?
See, as I said, if it's not your full-time, if investing is not your full-time job, then the starting point probably would be a multi-cap or a flexi-cap fund, where you let the fund manager decide the allocation to. Just pick the best stocks out of large, mid, and small, and let the fund manager build the portfolio.
Okay.
Then when you become a little more comfortable, or you're a bit more educated, bit more risk appetite, then you can choose the mid-cap or small-cap categories.
Okay. Let's talk about one of the biggest mistakes investors make. They focus only on buying, but they don't focus on selling. Under what conditions should an investor look at selling a particular company which has given her or him good returns over long term?
I'm assuming it's a stock-specific question.
Yeah, basically, what are the 3 biggest mistakes investors make while they invest in the equity markets?
So 2 things. See, at the asset allocation level, I think you should stay invested with a long-term view, right? So, but
it's about investors.
So, if you're talking about individual stocks, how to time your entry and exit, that becomes a bit more complicated. Because then you'll actually have to have a grip on the fundamentals and the valuations and all that, which is not everybody's cup of tea, so to say. The best thing is to let a portfolio manager or a PMS or AIF or mutual fund manager
or simply put your money in
do that job for you. But if you insist on doing it yourself and try to pick stocks, the first thing you should do is when you're buying, you have to be clear about the thesis that you're buying it for, the story that you're buying it for, or the expectations that you're buying it for. So this is the company, these are the growth prospects, these are the profit estimates, etc., etc. So you start with that thesis, and then again, this needs active monitoring. Once you invest, after all this valuations look okay and all that, then you have to keep monitoring your thesis, because companies declare results every quarter, they give you a commentary, and you have to keep testing whether your original hypothesis is still valid.
Okay.
Right. So that's one. So if your original hypothesis is not turning out the way it should be, that's a trigger to probably exit, because then you don't know what you're buying it for, right? So that's one. The second is you bought it at a certain valuation with a certain target price and valuations, and the markets have rewarded it way beyond what it deserves, so to say. So it becomes expensive. That's another trigger. So I think typically, as long as your thesis is panning out, and your, and when I say thesis, long-term thesis, I'm not saying a 1 quarter bad results you get out. No, don't do that. As long as, the macro and the thesis is the right direction, stay put. pay some attention to valuations. There will always be times of froth and all, but it corrects and then goes on. But again, how much euphoria is there is a subjective thing, right? So suppose you buy a stock with a 10-year perspective, then you know that there'll be 2-3 years cycle where the stock becomes expensive, then corrects, either price corrects or time corrects. Whether you want to time it here and then get in here, that's a complicated question.
Micromanagement.
Too difficult.
Okay. Any reasons why the large caps have been underperforming compared to mid caps and small caps? Even in the last 2 months when the markets were down, it was mid caps and small caps. Everybody is chasing mid caps and small caps. Any reason why large caps have been the laggards? If that is the right word.
You said everybody's chasing mid caps and small caps.
Yeah.
I say everybody's chasing, or the markets are chasing profit growth.
Okay.
Right. So I don't think there is any randomness in the behavior of the market. Markets are behaving rationally, and as I mentioned in the beginning, the broader market earnings results have been good for the March quarter.
Okay.
Right, and there have been more upgrades than downgrades. So there are pockets of growth, and those pockets of growth happen to be in the mid and small cap space, which is what the market is chasing.
Okay. And how do you look at the IT sector valuation? There's some figures that they've been down 40% from their highs. And as you said, the froth is out. The AI bubble is almost bust in the West.
Yes.
So do you think investors would look at this sector as a multi-bagger going ahead?
No, definitely not a multi-bagger. Whether you can make some 10, 15, 20%, probably yes, in the short term. Because right now, I think we are at the peak of pessimism towards IT services, especially the large cap IT services stock. And when there's peak of pessimism, there is always going to be a bounce back.
Okay.
But in my view, structurally, if the large cap IT companies continue with the same business model, which in my view is a commodity business model,
exactly,
they cannot grow at 15% or 20%. And I would say the whole revival of IT as a favorite asset class happened only post-COVID. Pre-COVID, the large cap IT companies had already decelerated to single-digit growth.
Okay.
Because of COVID, globally IT spending had to be ramped up because of work from home, online shopping.
Yeah.
Exponentially.
The entire infrastructure.
The whole infrastructure for work from home, massive explosion in online shopping, massive explosion in gaming because people had to, stay at home. So that required a lot of investments in the whole IT infrastructure. There was a kick to the IT spending, which tapered down. And now we are back to the pre-COVID growth rates of single digit.
Okay.
So it's not a high growth sector in the current business model. They have to do something new.
Okay.
But whether IT stocks can go up 10-20% in the short term, yes, probably yes, because there is always a mean reversion kind of a situation. But structurally, no.
After 2 years of back and forth and remaining stagnant for the last 2 years, do you think the Indian market is now ready for the next bull run? And every bull market has its own themes and stories, whether manufacturing, defense, AI, railways, whatever. How do you separate genuine long-term themes from market hype? As you already mentioned that you look at growth for not just 5 years, but 5 plus, 10 plus, 15 years. So how do you separate genuine long-term themes from market hype?
So as I said, our endeavor is to find stocks with high terminal value, which means that we try to find stocks which have a long runway of growth. The framework that we use to judge whether the runway of growth is long enough or what creates a long runway of growth. The framework for that we use is LIM, which is what we call leadership, intangibles, and megatrends.
Okay.
Right. So megatrends, for example, these are long-term trends which don't change, which are difficult to change. So, for example, our demographics, income levels are rising, savings will rise. So that's a megatrend. Digitization is a megatrend. The way we are using this Jan Dhan, Aadhaar, mobile, UPI ecosystem is a megatrend. Penetration of telecom is a megatrend. So there are certain megatrends. China plus one is a megatrend, right? Then you have, I would say, debt creation is a mega trend. India, for example, is a low debt country. While people say there's pockets of high debt, but in
Even
general,
RBI is concerned about
but that's only in smaller pockets.
the ballooning debt
Absolutely.
crisis over the Indian
That's
middle
in the
class.
smaller pockets, for example, which they kind of do from time to time. But as a country, if you see, India is the only country which has kept its debt to GDP flat for the last 10 years.
Okay.
Right?
That's
So,
commendable,
even corporate India, you see so many articles where corporate India has been deleveraging. Right? So, at the country level,
But isn't
at the
that also a
corporate
pain
level,
point? I mean, private investments have
so that
all but
that creates your
come down.
capacity to grow further.
Okay.
So as we just discussed in the beginning, you are seeing signs of private sector capex revival.
Okay. Yeah,
And
you mentioned that.
Yeah. So and equity is easy to raise these days, and debt they are under leverage. So using equity and debt, you can have a long runway of growth of investments in the country. Even at the household level, while absolute levels have gone up, compared to the rest of the world, we are still not that leveraged, so to say.
Okay.
So these are mega trends which drive the longer term thesis. Second is intangibles. As a company, if you have technology, IPR, brand, customer loyalty, certain amounts of culture, etc., that creates a big moat. So if you have mega trends backing you and you create a moat around yourself using technology, etc., brands, technology, distribution strength, etc., these create the conditions for you to grow for a long period of time.
Okay.
Right? Because you have the tailwinds of megatrends and you have created a moat for yourself. Right?
Yeah.
Most importantly, I would say, apart from these two, is the leadership.
Yeah.
Which means whether the promoters have the vision, the execution skills, and within that, do they have the hunger for growth?
Okay.
Right? The promoters or the management. When these three things come together, that creates the magic of a long-term growth rate.
Okay. So where do you see the convergence of LIM coming together for generating mega trends for the next 15 years, 20 years? What sectors, what themes spark your interest?
Sure. So we have three buckets, I would say. The first bucket is linked to income levels and demographics, which means premium consumption and financialization of savings. So as income levels rise, goods and services in the premium categories will grow faster, which we are already seeing. Gems and jewelry, liquor, SUVs versus entry-level cars, high-end bikes versus lower-end bikes, white goods. These are all categories which will grow faster, right? Financialized of savings, again, linked to demographics. You have all the capital market linked segments which will grow faster. Okay. Whether it's broking, wealth management, asset management, insurance, exchanges, R&D agents, depositories, all will grow faster. This whole ecosystem, which is catering to the rising savings pool, right? So that's one demographics linked theme. Second theme we see is all physical asset creation. So whether it's China Plus One is a tailwind, government PLI schemes is a tailwind, Atmanirbharta in defense is a tailwind. Right? So capital goods, engineering, construction, infrastructure, good quality real estate, both in residential and this thing, and within the sub-segments like defense, T&D, data centers, renewables. That ecosystem, physical asset creation will be a big theme going forward because, in my view, very clearly, we have maxed out our growth because of consumption alone. So India's growth has come from consumption and services, right? Yeah. I think we have maxed it out. From pure consumption and services, we can probably grow at 5%. Okay. Not more than that. That 5 to 8 or 5 to 7% GDP growth rate has to come by physical asset creation. Okay. So that's one big theme that we are looking at. So industrials is typically what we are overweight on. Okay. And the third one is new age companies, which use all this digitization and other platforms to create new business models. We believe that these are disruptive in nature, and the existing bunch of companies which have gone public, and some of them will go public in the near.
Would this also include quick commerce companies?
Absolutely, everything. Yes, absolutely. Because these companies have created a good moat around themselves. The first mover advantage in these cases is immense, and they can grow, for a very long period of time. So these are broadly the high growth segments that we are looking at.
Let's talk about something that most investors, including mutual fund SIP investors, are worried about. What if the markets were to crash for some reason, maybe geopolitics, maybe a black swan event, whatever? What if the markets were to correct 20%? What should SIP investors do if such an eventuality comes? I know this is too far-fetched, but still, if it
It's
happens,
not far-fetched. It will happen.
Okay.
At some point in time, it will happen. Maybe not tomorrow, but 2 years down the line, 5 years down the line, it will happen. And the whole concept of SIP is to take care of these kind of events,
Okay.
right? That you keep at it at all points in time, so that you are able to capture the overall dollar cost averaging concept.
You spent decades watching different market cycles. If you're advising your younger self today, if suppose you're 25-year-old Mihir Vora was starting to invest in 2026 with say 10,000, 15,000, 20,000, what would be the first 3 rules he would follow?
Well, first of all, equities as an asset class is only for the long term, right? So you have to be long-term positive on the prospects of the Indian economy. If that is the starting point, then everything else falls in place. So first and foremost, stay bullish, stay optimistic.
Okay.
Right.
On equities.
On equities and on India per se, right? So that's one. Second is don't underestimate inflation. Inflation over the longer term can hurt you. And that's also one of the reasons why you need to be in equities, because equity is a good hedge against inflation. But more importantly, if you're starting with 10,000 rupees, don't let it stay at 10,000 rupees. As your income levels and as your savings increase, you should keep adding to that pool, not keep it stagnant, because in the long term, that will also help you against rising inflation and in general living expenses. Okay. And the third is don't leverage.
Okay. I mean, most investors do that. I mean, the greed takes over the better senses.
You can leverage for mortgage, but not to buy equities.
Okay. And if somewhere to enter commodities, precious metals, because we've not talked about precious metals, they have given a huge rally, then they've corrected sharply. How do you look at this investing in precious metals? Do you think?
In general, I'm bullish on gold and to some extent silver also.
Okay.
And that's because of the longer term trend of money printing.
Okay.
The whole world is in a money printing regime, and I don't see, especially the Western world, I don't see a way out of it, because they are so neck deep in debt that the only way to service the debt is to print more money, right? So that is bullish for assets like gold. So some portion of your assets should be in these kind of assets also.
Okay. Final question: the investor who will create the most wealth over the next 20 years will be those who complete the sentence.
Are optimistic.
Okay. Mihir, this has been a very fascinating, insightful conversation. Thank you for simplifying investing for our investors. Thank you for joining us on the Rediff podcast.
Thanks for having me. It's been my pleasure.
Okay. Wonderful.